Hello, I'm Bernard Mathis. You're watching Mathis Financial Services. I started in the insurance industry in 1980, working part-time. In 1984, I became a full-time agent, and I've been doing this for several years. I want to talk about life insurance. Many times, persons only think about life insurance when somebody's going to pass away. Well, the conversation is always about life insurance, and it's still normally spoken and talked about in basically a negative term. But life insurance, there are actually 5 types of life insurance. It's whole life. Everybody knows about whole life. But as I said, there are 5 different types. There's participating whole life. It's what we call non-participating whole life. There are 2 types of endowments. And an annuity, which most people kind of associate with money, is actually a life insurance policy. It comes under the life insurance form. Now, let's talk about participating whole life. Participating whole life, as you saw from the caption, is a whole life program that pays a dividend. You say, what is a dividend? Well, you're participating in the company's profits, meaning that you start with, let's say a $10,000 insurance policy. At the end of the year, it pays a dividend. Now you got a $10,100 policy, and that continues over the life of the policy. In fact, if you run into a financial bind, you can actually go to the company and say, well, look, I have these dividends. I'd like to cash them in for cash because I'm having an issue. And they will send you a check, let's say for the $100. Your policy goes back to the baseline of $10,000. Now, the next type of policy is what we call a non-participating whole life. A non-participating whole life policy is a policy meaning that you're making payments, and as you make the payments, if something happens to you, then the policy pays the base amount, let's say again, $10,000. You do not participate in the company's profit position with the dividend, meaning that no matter how long you have that policy, it will stay $10,000, no matter how much money you put into it. So let's say you're a 30-year-old, you buy the $10,000 policy, you pass away 30 years later. You've probably paid about $15,000 in actual premiums, but the policy will only pay the $10,000. And that's why it's called a non-participating policy. It is a life policy, but it does not participate in the company's growth. Thank you. As we were talking, I said that there are actually 5 types of life insurance. The other 2 types are what we call limited pay or endowment plans. And what they do is you pay them for a specified time. You pay them like a 10-year time, a 20-year timeline, and at the end of that timeline, you don't have to make any more payments on the policies at all, because you've paid enough in that the growth on the policy itself will continue keeping the insurance in force. But you got to remember that it may be a participating or a non-participating type contract. So that's something that we need to talk with the agent about. Lastly, let's talk about annuities, which is actually the number 5 position. Okay, lastly, we're going to talk about annuities. An annuity is an insurance, but technically when we think of an annuity, we think of retirement. We really think of it as money. And that's truly what it does, because it does not offer any protection like life insurance. It's money in, interest earned, at your passing, that's what you get. But like I said, the main purpose of an annuity is retirement planning. And the reason I say that is because you only earn interest. And you need to look at the interest that you're earning, or let's say you have an annuity as an example. Usually annuity, the maximum that you're going to receive, unless you have a whole lot of money like 100,000, then usually your rates are going to be down in the under 2% range. if you had that same annuity with an insurance company, still some companies are in the 2% range. But if you look around, you may find some companies that are in the 4.5%, 5% positions. At one time, let's say 90 days ago, an annuity with an insurance company was paying 6.35, things of that sort, where the bank was still in that 2% position. But as I say, the objective of an annuity is for retirement. And you need to be putting away as much as possible, trying to earn the highest interest possible for your money. Because remember, the annuity is what you're going to live on for the rest of your life, or a portion of what you're going to live on for the rest of your life. So you need to be very careful. Check out some people like myself. I have 4.5% rate 5-year guarantees on annuities. I also have 5.5% guarantees in 3-year annuities, because the marketplace has changed that dramatically. And if you say you're about to retire, then you need to really think about where your annuity is, and is it going to last longer than you? Because you're constantly taking monies out. You may have a 401k or some other type of retirement. You have potentially some Social Security. Then that annuity that you put money into over the years is your go-to good time money, if you would, if you planned it properly. With annuities, planning becomes very much important in what you'll do with it out in the future. Thank you. If you have a question, please don't hesitate to call me. Mathis Financial Services. My number is 334-467-1108. You can email me at mathis7864@AOL, or you can Gmail me, bernard.mathis98@gmail.com. I thank you. Thank you for listening.